The long-awaited September jobs report finally arrived, and it delivered a mixed message. Job growth came in stronger than expected, yet the unemployment rate continued to rise. So what does that mean for the Fed as they head into their next meeting? At the same time, builder confidence is improving and existing home sales have now increased for the second month in a row, signaling pockets of strength in the housing market despite ongoing uncertainty. Good afternoon. Today is Tuesday the 25th, and we are approaching the end of November with just one more month to go in 2025. First off, I want to wish you a very happy Thanksgiving. I hope you are able to spend some quality time with family and loved ones and take a moment to appreciate everything we're fortunate to have. It's easy to get caught up in the day-to-day and lose sight of the gratitude, but Thanksgiving is the perfect reminder to slow down and reflect on the blessings we often take for granted. With that said, last week brought a few surprising economic reports that impacted mortgage rates and added new complexity to the upcoming Federal Reserve decision. Interestingly, the Fed won't be receiving any additional major data on inflation or the labor market aside from the weekly jobless claims before their next meeting. That means the reports already released will carry significant weight in shaping their monetary policy direction in the coming weeks. Let's dive into what took place last week. Here are your headlines. After delayed release due to the extended government shutdown, we were finally able to see how the labor sector looked almost 2 months ago. September job growth came in stronger than expected, with 119,000 jobs added versus the 50,000 forecasted. However, revisions to July and August reduced the previous totals, leaving August with a net decline of 4,000 jobs. This follows a 13,000 job loss in June, marking the first 2 monthly declines since December of 2020. The unemployment rate inched up from 4.3 to 4.4%. So what is the takeaway? Because of the government shutdown, the September jobs report was delayed, and the BLS will now release only partial October data without an unemployment rate, alongside the full November report on December 16th. The timing is important because that release comes after the Fed's upcoming policy meeting on December 9th and 10th. The Fed has already cut the Fed funds rate in both September and October as it works to balance above target inflation with signs of cooling in the labor market. Meeting minutes reflected significant disagreement with the committee, with the majority leaning against the December cut, and recent Fed commentary has reinforced the division. At the core, the Fed is weighing two conflicting objectives: keeping inflation under control while supporting unemployment. With September's mixed report stronger than expected job growth paired with a rising unemployment rate and no additional full jobs data arriving before the Fed meets, the odds of a December rate cut remain highly uncertain. Now, after being delayed by the shutdown, the BLS has released the last several weeks of jobless claims, and the trend remains the same. Weekly initial claims held between 220,000 and 235,000 throughout October and November. Continuing claims, which reflect the number of people still receiving unemployment benefits, stayed above 1.9 million each week, with the latest reading reaching 1,974,000. So what is the bottom line? While relatively low initial claims are a positive sign, the persistently high level of continuing claims, above 1.9 million since mid-May, suggests people are taking longer to find new jobs, and that means that the labor market is having trouble rebounding. Now, in housing news, the National Association of Realtors reported that existing home closings rose 1.2% from September to October, slightly above expectations, and were 1.7% higher than a year ago. Inventory dipped to just over 1.5 million units, but remained nearly 11% above last year's level. So what is the bigger picture? Because October's closings reflect buyers who were shopping in August and September, this data captures only part of the recent rate declines. That means upcoming reports may show even stronger activity. And in other housing news, home builder sentiment edged up 1 point to 38 in November, its highest level since April, according to the National Association of Home Builders. While the index remains below the key 50 mark that signals growth, the increase beat expectations for a flat reading. Buyer traffic and current sales conditions both improved slightly, rising to 26 and 41. Expectations for future sales dipped 3 points to 51, but remained above the 50 thresholds for the second straight month. So what does this mean for us? Uncertainty and buyer hesitancy are still present, but easy mortgage rates are helping affordability. National Association of Home Builders chief economist Robert Dietz noted that the group expects a modest increase in single-family home construction next year. This week will be a quiet week due to the holiday and the market being shut down on Thursday with a half day on Friday. We did receive some wholesale inflation this morning as well as retail sales, which, as mentioned in previous updates, is super important due to the incoming holiday season. We will cap off the week with some housing reports on appreciation and pending home sales numbers. Enjoy the quiet week with your loved ones, and I'll be providing an update in December.